All right, welcome to this episode of the Monday Minutes. Today we're going to talk about debt and the importance of debt in a portfolio, especially if you are late in the cycle. Now, one of the reasons that debt is important is that the non-correlation to the overall market conditions is very, very high when it comes to debt, especially if you have a low loan to value, if you're very well secured. So for example, if you're lending money and you're lending $60,000 and the collateral of that loan is a property that's worth $100,000, you're extremely well secured in the sense that there would have to be a pretty catastrophic market event to make that $100,000 collateral only be worth $60,000. And even in that case, you'd still be in a really good position in terms of getting your principal back. Now, there's other ways you can lose money investing in debt, but generally speaking, the non-correlation to market conditions is really critical, especially late in the cycle, like I mentioned. Also, when you're investing in performing notes that are paying on a monthly basis, you're just buying that stream of income, or you're lending money to someone that's fix and flipping, that they have an extensive track record in the business, the predictability of the outcome is significantly increased. And like I mentioned before, this is one of the main goals of why people invest, especially if you're investing for your retirement, which brings up another good point. One of the challenges with investing in debt generally is that you're not going to get the tax benefits that goes along with real estate. You don't own actual property, therefore you're not getting things like depreciation, not getting all the write-offs associated with real estate. So when you do receive income from debt, it's taxed as ordinary income. Now, a big reason that this is an interesting thing, especially when it comes to self-directed retirement, is that you can basically eliminate that problem if you have a Roth IRA or a solo K, for example. So a good strategy that a lot of investors use is to invest in equity in their names or in their non-tax deferred entities, and then invest in debt in their Roth IRAs, for example, because then you're getting that predictability of the outcome. You know, you can really accurately predict where you're going to be 10 years down the road, 20 years down the road, 30 years down the road, but you're not having to pay taxes on all that income like you would otherwise if you weren't using a tax deferred account. Now, one of the many reasons to invest in real estate, and I mean actually equity, right, owning the physical property, is that real estate is inflation resistant. So I know you guys are really familiar with this term, but just to clarify, the more that prices go up, the less the dollar is worth. Usually, real estate acts in a one-to-one ratio with inflation over a long enough time period. You know, it may go up 1 year, real estate will follow suit. Generally speaking, you're basically going to balance out. So if inflation is going up at 3%, generally speaking, real estate will go up at 3%. In fact, some people argue that the rate at which real estate increases is a more accurate representation of the inflation rate as opposed to CPI, for example. Now, with debt, again, because you're not owning properties, you're not getting the benefits of that inflation resistance. But think about it this way. Let's say you have a note where you invested $100,000 and you're getting an 8% interest rate, which would be $8,000 a year. That $8,000 a year is coming in regardless of the state of inflation. Now, what you don't want to do is have really serious hyperinflation, because that $8,000 a year will be basically worthless by the time the note's paid off. But in the event that there is deflation, meaning that prices come down, meaning that the dollar is worth more, that $8,000 a year is worth more later down the road. Now, just to clarify, deflation is something that doesn't happen that frequently. It can happen during recessions, and usually it doesn't last very long. So it's not a good idea to focus your entire portfolio based on the assumption that deflation will be long lasting. However, when it comes to diversifying, it's a good idea to have both the inflation resistance with the equity that you own, the properties that you own, and the deflation resistance through debt investments. Now, within the debt investment vehicle, there's an important distinction between amortizing debt and non-amortizing debt. So non-amortizing debt is very straightforward. It's basically simple interest. So let's say you invest $100,000 in a non-amortizing loan that has a 5-year term at an 8% interest rate. So you invest that $100,000, you're going to get that 8% interest rate every year. It's $8,000 for years 1, 2, 3, 4, 5. And at the end of year 5, you get your $8,000 for that year, and you also get the $100,000 of principal back. At the end, that's the totality of the investment. Now, with an amortizing loan, this would be like a typical mortgage. So let's say you buy a property, You have a 30-year mortgage. Every year, you're paying a little bit of that principal back, and at the end of the 30 years, you own the house free and clear. Now, you can also be on the other side of that transaction in which you are the one lending the money. In fact, I have purchased seller finance notes, which is essentially lending money, with a $100,000 loan value, an 8% interest rate, and a 7-year amortization schedule, a very short amortization schedule. And the shorter the amortization schedule, the more significantly they're paying the loan down every single year. So that's going to supercharge your cash flow. Now, granted, a lot of that is your own principal coming back, but it creates something interesting. So let's say, for example, with that $100,000 loan and an 8% interest rate and a 7-year amortization schedule, this would actually yield a 15.5% cash-on-cash return because you're getting a lot of your own money back during that investment period. And this is something to consider because let's say, for example, that you're leaving the corporate world and you want to really supercharge your cash flow in order to pay off your expenses. That's one thing. Now, of course, you're using some of your own money to do that, but it's just something to consider. And then I'd also say that it really decreases the risk profile of the loan if the borrower is paying it down so significantly because let's say, for example, that you start a loan at a 70% loan to value. Well, if it only has a 7-year amortization schedule, that 70% loan to value is going to get paid off and paid off and paid off. And therefore, the likelihood that the borrower is going to default is going to decrease and decrease and decrease. So again, really increasing that predictability of outcome through amortized loans. I will say, however, that as an investor, owning amortized loans can be a little bit annoying because you have to remember that that 15% cash on cash return, for example, that's not all profit. And if you spend all that money at the end of the 7 years, you're going to be left with nothing because you don't own the property. You don't have principal balance coming due because the principal balance has been paid off. So you have to actually calculate what is profit, what is not. You also have to reinvest the capital on a monthly basis if you want to achieve that overall 8% interest rate that the loan was originally made on. So I just wanted to cover that because I think it's important to have a good combination of investing in actual real estate, owning the equity of the real estate. I also think it's important to own debt. And then within the debt structure, I think it's important to at least discuss the difference between amortizing loans and non-amortizing loans. All right. Hope you enjoyed these Monday Minutes. Have a great day. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy. Leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.